When will you be comfortable that we've seen the limits of this? How many more months of data do you need?
Oh, we're just getting started. I mean, what we saw today was plenty of inflation without tariff effects. We didn't have a big increase in new car prices. We didn't have a big increase in apparel prices. But let's look at where we did see an increase. Airline fares have come down a lot because the airline industry was very weak. But if you look at the recent data on people going through TSA checkpoints, it's firmed up. And so domestic airline travel is now back on a positive year-over-year basis. We've got a lot of fiscal stimulus going to kick into the economy early next year. But also in the tariffs, even in July, we saw a lot of money collected, but it still equates to about a tariff rate of about 8%. We think this whole tariff rate is going to go up to about 14.5% measured by that later. So we've got most of this tariff increase still ahead of us in terms of just affecting the data. And then, people say, oh, the retailer's going to eat it. No, they're not. They just wrote the check. So of course it looks like they're eating it. Walmart writes a check, but eventually they're going to pass it on. And yes, they've got good margins, but how do they manage to sustain these margins? Because they're great at figuring out how to stiff consumers, and that's what they'll do. And so this thing will feed through. It's just a matter of a number of months. And inflation's going up, but it's going up very steadily, and it will be above, we think, about 3.5% in CPI by the end of the year.
You've made two important points here. One is that you believe that goods prices will continue to firm through the year ahead, and that you're not going to see an offset from services. Is that right?
That's correct, because what's going to happen is the economy is going to be slower in the second half of this year as this goods inflation feeds through. But the big kicker here that people are not talking about is the huge rush of income tax refunds that's going to kick in at the start of next year. It's going to be like an extra stimulus check. And that, we've seen what happens. You give him a mouse a cookie, he's going to want a glass of milk. You give an American consumer a stimulus check, they will spend it. And you're going to have a surge of spending in the first half of next year with limited supply because of all these tariff and supply chain disruptions. You're going to get a second round of inflation, which is going to sustain inflation well above 3%, which begs the question of, why again is the Fed cutting?
Well, that was
if inflation's heading the wrong way slowly.
That was my next question to you. What does the Fed do with this kind of data?
They should stay on hold. I think there's very little argument that in favor of the Fed cutting rates. Rates are not abnormally high. I don't know why they think 3% is a neutral rate in the long run. It doesn't equate to history before the pandemic. I think something 4.5% is more of a neutral rate anyway. But there is no urgency about cutting rates. Now, I think they will cut rates for political reasons, which is very unfortunate, but I don't think they should based on these data.
As you're talking, traders are actually adding to bets of September Fed rate cut because this basically came in line when it comes to inflation. But why for political reasons when actually we saw a trend, 3 months of not so great unemployment numbers?
Well, yeah, but if you look at the overall mosaic of employment, it's still growing. And remember, we've got a labour supply problem too. And one of the things that Jay Powell pointed out is he's not looking at payroll growth, he's looking at the unemployment rate. If we've got fewer jobs being created, but we've got fewer workers, then you've still got a certain amount of inflationary pressure. You just said that the growth potential of the economy has gone down. Well, they can't do anything about that. So if you're not, this economy is not going to spark a huge surge in unemployment. And I think the basic point is by the end of the year, we think maybe 4.5% unemployment. We think over 3% in inflation. They're missing their inflation target by more than unemployment. Therefore, they shouldn't be cutting.
You're just tallying this up, though, but you believe they will be cutting. So you've got a Federal Reserve cutting interest rates at a time when inflation is picking up. And the key phrase you used was second-round effects. You don't believe this is a one-off. You're actually going to see second-round effects in the first half of 26. Yeah. What's your market view on top of that?
Well, so I think the market view is not too bad because I think, for political reasons, I think unfortunately the Fed will cut twice this year, maybe 3 times next year. They'll get going and cutting. It's not going to really change the economy that much. But if you bring bring short rates down enough, it does push extra liquidity into the equity market. And so you could just maintain these bubbly asset markets. I mean, what we've got is a tortoise of an economy and a hare of a market. And we're just giving more sugar to the hare.